All right. So, good evening, students. Today we are going to learn something very, very important, what we call it as accounting equation. Why I said it is important because so far the principles, policies that we have seen, to a certain extent, we are going to apply them in order to assess our understanding as well as learn some more fundamentals related to accounting equation. Now, this is also called a balance sheet equation. I'll explain you why it is so. Now, the double entry system which we started with in today's scenario when it comes to double entry system, wherein every transaction, you name it, any transaction that is likely to happen in business is going to there is going to be dual effect. The transaction will have dual effect in the sense that it is going to be entered at two places. So this is we are going to assess it in this accounting equation as well. So I'll start with an example. Let us see, this is a bookshop. So I would expect you to think of what can be assets for this particular bookshop, and correspondingly what is the probability of the liability for the bookshop. Now, in order to start this bookshop, there was, let's say, 1 lakh rupees of capital that has been invested by the owner. All right, so 1 lakh rupees of capital. Now how is this what is it means in accounting term? As I have already stated that there is a businessman and business. Both are having different entity. From accounting perspective, they are different. They are not one and the same from accounting perspective. So unless we keep this in our mind, the differentiation cannot happen. I would suggest you or uh, very categorically, I state that all of you should be thinking of that businessman is different and business is different. Business has its own entity, businessman is an individual. There may be a situation that businessman himself is running the business, but from accounting perspective, they are two different entities. Now, let's say 1 lakh rupees, which has been introduced by businessman to his business of stationery shop. Now, so business, this is we are preparing it for from business point of view. Any entry that is going to happen from business perspective, not businessman's perspective. So when he introduces 1 lakh rupees of capital with which he is likely to do business, then what is this is the transaction that has happened. So there are two impacts. One is there is a capital, and the second one is there is cash. He brings cash along. So let's presume this is our balance sheet, though it is in the same format, but we will understand it furthermore deeper. But for understanding sake, I have categorized it into two. One side is asset side, the other side is liability side. Okay, this is how we maintain balance sheet. Now, when a capital is introduced in the business, what all happens? So there is a cash which has come to the business. So cash being an asset, so there is a cash which is available now with the business. So we will be entering it as cash in the asset side. So let's say 1 lakh rupees which he has brought. So we'll write here 1 lakh rupees. All right. Now with this cash, what he does some expenditure in order to establish his business. So alongside cash, now there is a capital which also gets affected because there is capital, the liability which is due to the owner in the name of accounting term, we call it as capital. So there is a capital which has come to the business 1 lakh. Now with this dual transaction, what is happening? The total of both the side is equal. There is an increase in asset. There is also an increase in liability. So we have seen this resulting in when the businessman brings capital to his business. Now, secondly, what he would have done out of this capital. So we will see here, he would have bought this counter wherein the books are placed here. So buying this counter for business purpose, he has spent some money. And what is the amount that he has spent? So counter, let's say he has spent 50,000 rupees. Okay. So what is its impact? Which are the two accounts which get affected because of this transaction? The first one, there is a counter that has been brought to the business. So there is asset which is increasing in the name of counter. And second impact is we have paid the money in cash. So there is a cash which is getting deducted because of the payment that is made to the person who has supplied the counter. So cash is decreasing and there is increase in an asset in the name of counter. So there is an increase. So we will show here cash which was there 1 lakh. Now this cash will get reduced. So we have paid cash. So cash which is 1 lakh. Now since we have paid 50,000 rupees for buying the counter, now our cash balance has reduced to 50,000. It has gone. Now what has come in the business against the cash? So there is a counter. This is the counter, whole thing which we call counter, wherein the shop owner keeps the books and other stationery material which he is supposed to sell to the buyer or retail customer who walks in there. So there is a counter, now 50,000 rupees of increase in counter, and there is 50,000 decrease in cash. Resultantly, the total balance has remained the same. There is no change in the total balance, but there is change in asset. One asset has increased, the other asset had decreased. Now, the next thing is, supposingly, the business has bought 20,000 rupees of books, additional books. So when he has bought additional books of 20,000 rupees, what is the, and this is on credit. So he's not paying cash immediately. What is its impact on the business? Since it is on credit, the name of the supplier is important. We will name it as creditor. So there is an increase in creditor. And secondly, books have come into the business. So we will add to books. So there is an increase in books. So both assets in the form of books have increased and liability in the form of creditor has increased. So we will write here creditor, which is, sorry, we will write here uh, books. Now we will write books here. So how much of books we have bought? 20,000 rupees. So we'll write 20,000. And then there is increase in liability because the creditor has given us some time to make the payment. Till then, he stands as a creditor. So we will write 20,000 here. So there is an increase in the total value, but balance remains the same. So I hope now you have understood what is that elaboratively we are going to study now. So we are going to study the impact of any transaction on the balances that we have in the balance sheet, be it asset or be it liability. All right. So this is what I hope by now elementary level of understanding you have gained. Let's move ahead and understand a little more on it. I've given you the preface. Now the learning objective which is going to be there today is going to be the meaning. What is the meaning of accounting equation? Then effects of transaction, what impact it creates to a certain extent I have touched upon in the bookshop example. Process of preparation, how we do it as per the defined process, the rules related, and effect of adjustment transaction. So this is what when there is an adjustment transaction, adjustment means outstanding or prepaid. So these are, we have seen accrual basis principle. If there is outstanding or prepaid, it requires to be treated in the books of account as per the double entry system wherein accrual principle gets followed. Now we will see here the meaning first. It is a mathematical expression. Now this is very important. It is a mathematical. Is equal to B, asset is L, asset is equal to liability. That is what we have seen in the table above. So it is a mathematical expression based on dual aspect of accounting. Since every transaction has dual impact, be it increase in asset, decrease in asset, or increase in asset and increase in liability. So it is important to understand that the mathematical expression based on dual aspect of accounting is what the meaning of the term accounting equation. Now I have written here asset is equal to liability plus capital. Now liability here can be we can understand it in this way. Liability, which is capital, owner's liability to the owner by the business is capital, and liability to outsider who is a supplier or a vendor. So outsider is also a liability. So these are external liabilities and internal liabilities. So we have to understand what is due to the businessman for which he takes the profit, what is due to outsider which for which he has supplied the goods or we have bought something on credit, what we call it as creditor. So assets is equal to liability plus capital, which is to a certain extent we have understood in this bookshop example. Whatever transaction we do, it is likely to be the same. Let's see now effects of transaction on accounting equation. Now it is divided into affect two. One is affecting two items and second more than two items. So if there are two items get impacted, how is the treatment going to happen? If there are more than two items get impacted, how is the treatment going to happen? So this is effect of transaction on accounting equation. A little more, which we will be studying now. Now, transaction affecting two items. What are they? Let's say increase in asset, increase in liability. Now, when there is an increase in asset, we have bought books, we have bought counter in our example. there is an increase in asset. Had it been on credit, there would have been equal amount of increase in liability. So bought asset on credit. So there is a liability. Bought goods. Goods means for a stationery shop owner, goods can be defined as books which he buys for the shop to resell, anything that is bought for resale. Stationery, pens or pencil, whatever. Usually a book shop owner buys these things in order to resell. So there is decrease in liability, increase in asset, increase in liability. Then comes decrease in liability and decrease in asset. This has dual impact. What gets impacted? Decrease in liability means we are paying the creditor, the person from whom we have bought books on credit is now being paid. So what are the two accounts get affected here? One is creditor and second one is there is cash which gets reduced. So creditor and cash both. So this is creditor. There is decrease in creditor and cash is also decreasing because we are making the payment in cash. I hope this is understood. Let's see the next one. Increase in asset and increase in owner's capital. In what scenario, think of assets gets increased and owner's capital gets increased. So in this scenario, first, if he brings additional capital, there is increase in asset. Why? Because cash increases, and there is increase in owner's capital. So there will be increase in capital. This is one. If there is profit, let's say for example, if there is profit, so who is entitled to get the profit? It is none but the businessman because he bears the risk of running the business. So if there is profit, that gets added to capital. So it gets added to capital. So there will be increase in capital. I hope you're getting it. So increase in asset and increase in owner's capital. Decrease in owner's capital and decrease in asset. So decrease in owner's capital. If he does some, if he takes out some money from the business for his personal use, that is drawing. We call it as drawing. So when he draws money from business for his personal use, there is a deduction from capital. So capital minus drawing. And decrease in asset. Say if he has taken cash from business for his personal use, then there is decrease in asset, decrease in cash. Now decrease in liability and increase in another liability. So what happens? There is decrease in liability. Liability gets decreased. Any uh, supposingly, if taken, we have paid to our creditor. Some payment is made to creditor, but through a loan, short-term loan taken. So short-term loan is what? It is nothing but a liability. So there is a liability that has impact. We will increase the liability because of the loan that we have taken, which gets categorized as outside liability, and we have made some payment from there to the creditor. So there is decrease in creditor. So if anything of this nature which impacts in the liability side, both the items which are appearing in that, or one item gets created and other item gets impacted. So this is the scenario of decrease in liability and increase in another liability. So there is decrease in liability, increase in another liability. So I hope all these points, these are very important. You don't need to remember them or memorize them, because if you memorize, you may forget. Understand the concept. This will enhance your knowledge on accounting, not only on this particular chapter, on subsequent chapters as well, because these concepts are very, very important. And uh, concepts we have already studied, but to a certain extent, we are applying them now through these changes which are likely to happen due to a transaction in our balance sheet, which is items increase, decrease, value increase, decrease. Let's see the next one, transactions affecting more than two items. So here, in whatsoever situation that we have seen, only two items were affected. Now here, transactions affecting more than two items. Let's say sale of goods at profit or loss. Now, when we are selling goods at profit, so there will be goods, there are which all accounts get affected. There is goods, then there is cash, and there is profit. All right. So what will happen? Goods will decrease. There will be decrease in goods because we are selling goods. What will increase? The asset. Cash will increase because there is inflow of cash. Supposingly, if goods worth rupees 20,000 was sold at 25,000, so there is 5,000 rupees of profit. 5,000 rupees of profit. Now there will be decrease in goods 20,000. There will be increase in cash 5,000, 25,000, and 5,000 of profit, which will be added to the capital, because the ultimate happening of the whole business transaction, the businessman either gets the benefit or bears the loss. So there is a profit, it gets added to the capital. So what happens here? There is decrease in goods by 20,000, increase in cash by 25,000, and furthermore increase in capital by 5,000. So the balance is equal. There is equal amount of increase in liability and equal amount of increase in asset by 5,000. I hope this is clear. Now let us see the process of preparing accounting equation. So this is something which we have to understand how to do it. So far we have understood the concept behind and the way it impacts our assets and liability items. Now what are the processes or how we need to follow them in accounting? Now ascertaining assets, liabilities or capital affected by a transaction. First thing we have to uh, analyze or ascertain what has impacted because of this particular transaction, whether there has been change in assets or liabilities or capital by a transaction. So first thing of assessment is this. Second, decide the effect on asset, liabilities or capital. how much of impact this transaction has created on assets, on liabilities, or capital, and then recording the effect on the relevant side of the equation. To a certain extent, we have already seen that both sides, if it gets impacted, entries are to be made on both the sides. Now let us see furthermore on this in the process by taking few examples. Now, commenced business with rupees 20,000 as capital. So we have seen that what has been the impact when there is business commenced with 20,000 rupees as capital. So there will be cash and capital. These are the two items get affected. So cash will increase by 20,000 and capital will also increase by 20,000. I hope this is okay. Purchase furniture for rupees 500 in cash. Now what happens? Furniture gets impacted. This is one item, and cash gets impacted. So what happens? There is increase in furniture and there is decrease in cash. Purchase goods for rupees 1,000 in cash. So what happens? There is, which are the two items which gets affected? So one is goods and second one is cash. So when we are purchasing goods, so goods will be increased and cash will be decreased. Purchase goods for rupees 1,000 on credit. So what are the two accounts get affected? One is goods and second one is creditor or the supplier who has supplied. So we have to write his name here. But since it is not mentioned there, so we are keeping it as creditor. So goods, there will be increase in goods, addition in goods, and there will be addition in creditor. Now, sold goods costing 2,500 on credit for rupees 4,000. Now, this is impacting dual side. I mean, impacting more than two. So goods are sold for 2,500. So there is goods. One item that gets affected is goods. Second item that gets affected is creditor. And third is there is a profit. So goods increase. There is increase or plus. There is sales of goods. So it will not be plus. There is minus. So we will deduct it here. So we will deduct. So there is less of goods, then there is, since we are selling it on credit, so there is another name. It is it is selling on credit, then creditor does not get impacted. Just keep in mind, since it is credit does not mean it is creditor. So there is another term called debtor, debtor. Debtors are the buyers from whom we have to receive money for goods that we have supplied to them. So there is decrease in goods, there is increase in debtor, and there is a profit of 1,500 rupees. All right. So goods gets decreased since it is selling happening there. Then debtor, from whom we have to receive money. So there is 2,000 rupees of debtors. So there is an asset since it is a receivable. So it is an asset, and credit uh, for rupees 4,000. So if we deduct this 2,500, 4,000 minus 2,500, so 1,500 is the profit. Profit gets added to capital. So this is to be added to capital. So capital gets plus by 1500, goods gets deducted by 2500, and debtors to whom the goods were sold, there will be increase in debtor by 4000. So I hope this is clear. So goods 2500, there is a reduction in goods, there is increase in debtor on one side, which is assets side, and so final impact is 1500. There has been increase in asset side. Similarly, on the liability side, since we are adding this 1500 to capital, there is increase in liability side as well by 1500. So the balance gets equated. Paid rupees 1000 for rent and 5000 for salary. So rent we have paid is an expense, and 5000 salary is also an expense. So both these gets both these impacts the capital. So there will be rent and salary, these two things which are there. So there will be deduction in capital. So there is decrease in capital and there will be decrease in cash. So liability side decreases by 6000 because these two expenses are finally to be deducted from the capital. Since profits gets added to the capital, expenses also or income gets added to the capital. Similarly, expenses gets deducted from the capital. So we are deducting it. 5 plus 1, 6000 rupees gets deducted there from capital, and cash also of the same value gets deducted 6000. This is the impact of our this particular transaction. Rakesh withdraws rupees 2000 for his personal use. So what is the name? What is the term that we use to indicate that there is withdrawal by the businessman for his personal use? We call it as drawing. Drawing. All right. So there is a drawing that gets impacted, which is resulting into decrease in capital by 2000 for his personal use, and there is decrease in cash because he withdraws money in cash. So 2000 decrease in capital and 2000 at the same time decrease in cash. So we have understood now that any transaction which happens in business, be it impacting two items or be it impacting more than two items, under any situation, it is going to have the same impact, that the equation gets balanced. So this is what we have seen with these above examples. Now let's go ahead and understand a bit more through this illustration. Now show accounting equation on the basis of the following transaction. Gurman started business with cash 1 lakh. So we are now very clear. There are two things. One is cash and there is capital. So there will be increase in cash and increase in capital by 1 lakh rupees. All right. Purchase goods in cash 50,000. So there will be increase in goods. So goods increases by 50,000, and at the same time there is cash decreases by 50,000. Purchase furniture from Messrs. Samrat Furniture. So name is given. That means it is on credit. So furniture is purchased. The furniture gets increased and Messrs. Samrat Furniture, since it is on credit, so there is a liability in the name of Samrat Furniture. Okay, so there is increase in liability. Sold goods costing 2,500 for 35,000 against cash. So when goods are sold 25,000, so there is goods which gets decreased by 25,000, then 35,000 for rupees 35,000. So there is an increase in cash by 35,000 and difference is profit. So there is an increase in profit which gets add what account gets impacted because of profit? It is capital. So there will be 10,000 rupees of increase in capital. I hope this is understood. Samrat Furniture was paid in cash. So from whom we bought on credit previously for 20,000 rupees furniture, now they are paid back. So what we are going to do? So Samrat Furniture is paid. So there was a liability which was appearing for 20,000 rupees of furniture which we bought. So that liability, which is Samrat Furniture, gets deducted. So there will be less by 20,000 in liability. So because Samrat Furniture is paid, so now it does not exist in the book and there is decrease in asset side. Cash also gets decreased by 20,000. I hope this is clear. So we have discussed these transactions. You can work upon this. Now, role of double entry system. Rule of double entry system will always hold good. So this is very important. The rule what double entry system has, it is always going to hold good in whatever be the scenario, transaction scenario. So assets is equal to liability. Asset can be broken down further, maybe debtor, maybe assets, maybe cash, so stock, whatever that comes in asset side, equal amount of liability gets created. So this is the rule. Double entry system impacts onto our items which are going to appear in the balance sheet in the name of assets and liabilities. Both will equally get impacted, which both sides will get equally impacted, so that balance remains intact, in the sense that there may be increase in balance or decrease in balance is a different thing, but both balances will tally, be it on asset side or be it on liabilities. Now let's understand a bit more. Effect of adjustment transaction on accounting equation. Now outstanding expenses. These are adjustment transaction. So expenses are outstanding as per accrual basis of accounting. The principle says that whether we have paid or not, it is immaterial. But since we have received services or given services, it has to be entered in the books of account. So outstanding expenses means services we have received. So therefore, the expenses are to be treated in the books of account. So how it is going to impact? There will be capital, one item which gets impacted. If at all, there will be decrease in, if there is an outstanding expenses, so this expenses will ultimately decrease our capital and increase our liability. How come? So liability gets increased and capital gets decreased because this is an outstanding yet to be paid. But services we have already availed. Therefore, we will treat it as an expense, thereby deduct our capital to that extent and increase our liability. The capital gets deducted, liability gets increased. Prepaid expenses. So expense which is paid in advance. Services are yet not received. So if there is a prepaid expenses, then how it is going to impact? If we have prepaid, so there is anything which is prepaid is an asset. So there will be prepaid expense which gets added in our asset side. So because this is a the assets which are appearing there, so we will increase our asset because we have paid in advance, but services are not yet received. Then there is decrease in cash. Since we have paid out of cash in advance, therefore there will be decrease in cash. If this be the scenario that there has not, it is not a prepaid but a real expenditure met, then there will be decrease from the capital. We will not show it as an asset. Expenses which are done gets decreased from capital, but since we have not availed the services, this prepaid is going to appear as an asset till the time we get the services. Accrued income. Accrued income means earned but not received. Not received. So we have earned income, but we have not yet received. As per accrual principle, even if we have earned, forget about receiving it, we will treat it in the books of account. So earned income will be added to capital where the income gets, which item gets impacted. If there is income, so capital, so capital there will be plus increase in capital, and there will be increase in cash. Since we have not yet received cash, it is earned but not received, so there will be an asset in the name of accrued income. Or if there is any specific name given, so we will write that there will be increase in asset because of accrued income. Even if money is not received, if money would have been received, then there will be increase in cash. If it is not received, so we will show it as an accrued income in the asset side till the time we receive that accrued income in cash. Capital will be increased to the extent of accrued income. Now, income received in advance. Now, the just opposite to this, it is unearned income. Since it is unearned, we have not yet received, we have not yet provided the services, but we have received the money. So income received in advance is what for the business? It is liability. So there will be increase in liability. Unearned income by the name unearned income So one liability gets increased, and since we have received already, so it has impacted our cash. So cash will be added. Since we have received the money, but services are yet not received, so this money is yet to be, services are not yet given. So this money, till then we provide the services, it will appear as a liability. Even if cash is received, services are not given, it is appearing as a liability. So income received in advance, which is an unearned income. If it happens to be unearned income, which we have received, so there will be increase in cash certainly, but there will be increase in liability to that extent as well. Now, calculation of total asset, capital, and other variables. So let us see, if capital is equal to 70,000, liabilities are 40,000, what would be the total asset? So we have seen that there are assets, there are liabilities. So capital is put up here, capital, there is 70,000 rupees of capital, and there is a liability of 40,000, means outside liability of rupees 40,000. So put together is 1,10,000. Since asset is equal to liability, total asset is equal to total liability. So assets are in the form of cash or others will appear as 1,10,000. So total here appears as 1,10,000. Asset is equal to, so capital is going to be, total assets are going to be 1,10,000. I hope this is understood. Let's have a recap of what we discussed. So we have understood the meaning, that mathematical equation, assets is equal to liability. There may be change in a particular asset or particular liability, which will certainly impact the other item in the balance sheet. Effect of transaction, we have seen how it has impacted. We have taken few examples there as well. The process of preparation, how we prepare the accounting equation, the rules that we have seen, dual entry system, how it impacts, and effect of adjustment transactions, the outstanding or prepaid, how we are going to treat them in the books of account. So I hope you have understood this. By and large, this particular chapter we have touched upon on, roughly to a surface level. A little more deeper we will go when we start working on questions. So in my next class I'll take up few questions and we will work as per the prescribed format, so that you have further more understanding on this. But conceptually I believe you must have understood. So it was wonderful talking to you all and explaining the whole concept. I believe you must have taken the whole thing. In case there is further more required, you can rewind the video and have a look at it, because everything which should be understood in this particular chapter, I have tried to explain you with some illustrations and examples, and how it every all the items get affected, be it, two items getting affected or more than two items getting affected because of a particular transaction. So I would expect students and viewers to like, in case if you have liked the content, or you can dislike it as well. Subscribe it, so that the next videos which I'm going to upload, you will have a notification on the same. Share it precisely for the students. You can share it to your group, your uh, other students in your class, in your society wherever you are putting up so that they happen to know of it. Mention feedback in the comment. This is something very important. I would expect you to mention your feedback because your feedback is very important. And as a teacher, everyone wishes to know how is the understanding about the topic that he has explained. So I would certainly expect your comments, feedback. If there is any suggestion, you can make a mention. I will try to incorporate that to the extent possible. Ultimate objective is to help you understand and do better in accountancy. With this mission, with this objective, I am taking up these, and I would certainly help you understand it to the fullest extent with respect to the concepts which are there in accounting. I reiterate by telling you don't need to memorize things. All that you need to do is to understand the concept. It will fall in your process of doing numericals when you move ahead. So thank you once again. It was wonderful talking to you all and explaining the concepts. Next chapter, we will take up few questions on this particular chapter. For now, thank you.